Silver just crashed 5% in a single session from $80 to $75. Gold dropped 171, 3.2% gone in hours. And the reason is a number that most people scrolled past on their newsfeed without understanding what it meant. PPI came in at 0.7%. The forecast was 0.3, more than double what the market expected. And that one number killed every rate and cut hope for 2026, destroyed it. The Fed is not cutting rates. Not in April, not in June, maybe not at all this year. And the market responded by dumping everything that does not pay a yield. Gold, silver, both destroyed. But here's what happened. On the exact same day that silver crashed to 75, JP Morgan pulled 1.6 million ounces of silver out of their COMEX vault. StoneX pulled 1.2 million ounces. HSBC pulled another 20,000. Total 2.8 million ounces drained from COMEX vaults in a single day. On the same day, silver crashed, the price went down, the metal left the building. And I need you to sit with that contradiction for a moment because it is the most important data point of the entire week. The fear and greed index hit 18, extreme fear, the lowest reading in months. Markets are terrified. And while markets are terrified, the vaults are being emptied. Someone is using the fear to take physical metal at lower prices. And I am going to show you exactly who, exactly how much, and what it means for what comes next. Stay until the end. Welcome to the hidden economy. Hit subscribe and hit the hype button. Drop a comment right now. Tell me, are you scared or are you accumulating? Because by the end of this video, you will know which one you should be. Let me break down the PPI data because this is what triggered the crash. And most people do not understand how bad these numbers actually are. PPI stands for Producer Price Index. It measures the prices that producers pay for goods before those goods reach consumers. It is the leading indicator of consumer inflation. When PPI goes up, it means the cost of making everything goes up. And eventually, those costs get passed to you at the grocery store, the gas pump, at the mall, everywhere. The headline PPI for February came in at 0.7% month over month. The market expected 0.3%. That is not a small miss. That is more than double the forecast. When an inflation number comes in at more than double what economists expected, it sends a shockwave through every market on Earth because it means the models are wrong, the forecasts are wrong. Inflation is not cooling, it is accelerating. Year over year, headline PPI hit 3.4%. The market expected 2.9%. That is the biggest jump in 12 months. Inflation is not just hot, it is getting hotter month after month. And the trend is going the wrong direction for anyone hoping the Fed would cut rates. Core PPI, which strips out food and energy at 3.9% year over year. That is the fastest pace of price increases in 3 years. 3 years. We are back to the inflation levels that forced the Fed to start hiking rates in the first place. Except now the Fed cannot hike because the economy is weakening from the war and it cannot cut because inflation is reaccelerating. The Fed is trapped, and a trapped Fed is the worst possible outcome for markets because it means no help is coming. And the food numbers inside the PPI report are terrifying. Food prices rose 2.4%. Vegetables up 49%, 49%, nearly half. Fruits up 10%. These are not luxury items. These are the things people need to survive, and they are getting more expensive at a pace that is going to hit every household in the country. I want to pause here because I think most financial channels will skip over the food data and go straight to what it means for gold and silver. But the food data is the most important part of this report for regular people. Vegetables up 49% means the salad you buy at the grocery store costs almost 50% more than it did last year. Fruits up 10% means the apples your kids eat in their lunchbox cost more. And these price increases are at the producer level. By the time they reach the consumer after transport and retail markup, they will be even higher. This is the inflation that people feel in their daily lives, not the inflation that economists debate on TV, the inflation that makes you look at your grocery receipt and wonder what happened. And here is what connects the food inflation to gold and silver in a way that most people do not think about. When food prices surge 49%, what is happening to the purchasing power of the dollar? It is collapsing. Every dollar buys 49% less vegetables than it did a year ago. That is not gold going up. That is the dollar going down. Measured in food, measured in energy, measured in everything. And gold and silver are simply reflecting that decline in purchasing power on a longer time frame. The crash today is a paper market reaction to a rate cut expectation. The long-term trend is a currency that buys less of everything every single year. And no PPI print changes that trend. It actually confirms it. Now, here's why this killed gold and silver. When inflation is hot and the Fed cannot cut rates, the dollar stays strong. A strong dollar crushes metals because gold and silver are priced in dollars. When the dollar goes up, it takes more dollars to buy the same ounce. But the demand from non-dollar holders drops because the metal becomes more expensive in their currency. And the futures market prices this in instantly. The algorithms read the PPI number, calculate that rate cuts are off the table, and sell gold and silver within milliseconds. That is what happened. Gold went from 5016 to 4800. Silver went from 80 to 75 milliseconds of algorithmic selling based on one inflation print. And the oil situation is making everything worse. Brent crude is above $100 because the Iran war is disrupting 20% of global supply. When oil is above 100, the cost of transporting everything goes up, the cost of manufacturing everything goes up, the cost of heating and cooling goes up, and all of that feeds directly into PPI. The war is creating the inflation. The inflation is killing rate cut hopes, and the killed rate cut hopes are crashing metals. It is a chain reaction. War to oil, to inflation, to Fed, to dollar, to metals. And right now, every link in that chain is working against gold and silver. But here's what I need you to understand about this chain reaction. Because I think most people are only seeing the short-term links and missing the long-term picture. Yes, hot PPI kills rate cuts. Yes, no rate cuts keeps the dollar strong. Yes, a strong dollar crashes metals. That is the short-term chain. But what is the long-term chain? Long-term, the chain looks completely different. War keeps oil above 100. Oil above 100 keeps pushing PPI higher. PPI keeps going higher, which means inflation is not transitory. Inflation not being transitory means the purchasing power of the dollar keeps declining. The purchasing power declining means gold and silver are worth more in dollar terms over time, not less. The short-term chain says sell metals. The long-term chain says metals are going much higher. Because the very inflation that is crashing them today is the reason they exist as an asset class. Think about it. Gold did not go from 250 to 5,000 because of rate cuts. It went from 250 to 5,000 because the dollar lost purchasing power over 2 decades. The PPI at 0.7% is confirming that the dollar is losing purchasing power at an accelerating rate. That is long-term bullish for gold and silver, wildly bullish. The fact that the paper market is interpreting it as bearish because of rate cut expectations tells you the paper market is trading the short term and ignoring the long term. And the vault data tells you the smart money sees the long term and is taking physical metal right now. The Fed being trapped is not bearish for gold and silver. It is the most bullish possible outcome. A Fed that cannot cut because of inflation and cannot hike because the economy is cracking is a Fed that loses control. And when central banks lose control of their monetary policy, gold does not go down. It goes parabolic. That is what happened in the 1970s when the Fed was trapped between oil inflation and recession. Gold went from 35 to 850. That is what is happening now. The PPI data is confirming the trap. And the trap is the setup for the next leg of the gold and silver bull market, not the end of it. But here is where the story flips. Because while the paper price was crashing, the physical market was telling a completely different story. Pull up the COMEX Silver Vault data on screen. Report date March 18th. Activity date March 17th. Only 3 inventory movements in the entire COMEX Silver Vault system. Only 3. But look at the size. HSBC withdrew 19,930 ounces. Small, normal, nobody would notice. JP Morgan withdrew 1.6 million ounces from one vault. In one day, at $75 an ounce, that is over $120 million of physical silver walking out the door of JP Morgan's vault. On the same day, silver crashed. StoneX withdrew 1.18 million ounces, another 1.2 million ounces from the same company, paying 12% to lease silver from retail investors through monetary metals. StoneX is so desperate for silver, they are paying 12% per year to borrow it from people like you. Normal lease rates are 1 to 2%. They are paying 6 to 12 times the normal rate. On top of paying 12% to borrow silver, they are pulling over 1 million ounces out of COMEX as silver crashes. That is not a company that thinks silver is going lower. That is a company that is grabbing every ounce it can find. Leasing at 12%, COMEX withdrawal at 1.2 million ounces simultaneously. That tells you the shortage is not theoretical. It is operational. They need the metal right now, today, not next month. And they need it badly enough to pay premium rates and drain vaults at the same time. Total withdrawn from COMEX silver vaults in one day, 2.8 million ounces. COMEX silver total dropped to 335 million ounces. Registered silver, actually available for delivery, is 78.9 million ounces, and it keeps shrinking. I want you to hold 2 numbers in your head at the same time. Silver price, $75 down 5%. Silver leaving COMEX vaults 2.8 million ounces up massively. The price says silver is worth less today than yesterday. The vault data says someone wanted 2.8 million ounces. They wanted physical silver badly enough to pull it out during a crash. Those two facts cannot both be telling the truth. One of them is lying. And I know which one has lied before. The paper price has lied every time. It lied in October when London froze with 0 offers. It lied in November when the CME halted. It lied in February when the CME halted again. It lied when Shanghai was paying a 13% premium. And it is lying now because you do not pull 2.8 million ounces of physical silver out of a vault on the day the price crashes unless you believe the crash is temporary and the physical metal is worth more. JP Morgan knows this. They paid a $920 million fine in 2020 for manipulating precious metals markets. They know exactly how the paper game works because they ran it for decades. Their traders were convicted of spoofing, placing fake orders to move the price, and then canceling them. They did this thousands of times, and they got caught, and they paid the fine. And now, they are pulling 1.6 million ounces out of their own vault on a crash day. I want you to think about what that tells you about their view of the market. This is a bank that knows every trick in the book because they wrote the book. They know when the price is being artificially suppressed because they used to be the ones suppressing it. And now instead of adding metal to the vault to prepare for deliveries, they are removing it. They're taking it out, 1.6 million ounces, over $120 million at current prices in one day. When the bank that was fined for manipulating silver lower starts taking physical silver out of the system during a crash, you need to pay very close attention because they are not doing this for fun. They are not doing this for a trade. They are doing this because they know something about where this market is going, that the paper price is not yet reflecting. And whatever they know, they want the metal in their hands, not sitting in a COMEX vault where it can be claimed by someone else. I have seen a lot of things in this market that made me pause. This one made me stop. JP Morgan draining 1.6 million ounces on the same day. Silver crashes 5% is not a coincidence. It is a playbook. Crash the paper, grab the physical, repeat. Now, let me show you where silver is on the chart because the technical picture is at a critical decision point. Pull up the silver 4-hour chart. You can see the descending trend line coming down from the $121 highs. And you can see the ascending trend line that has been supporting silver from the lows. Those two lines are converging, and silver just crashed right onto the ascending support line. $75 to $76 is where that support sits. Silver is touching it right now. This is the moment. If this trend line holds, silver bounces from here, and the crash was a shakeout. A final flush of weak hands before the triangle resolves to the upside. If this trend line breaks with conviction, silver has room to fall to the low 70s or even the $64 area. Where the previous low was made, both scenarios are possible. I'm not going to pretend I know which one plays out. Anyone who tells you they know for certain is lying or selling something. But here is what I do know. The trend line is being tested at the exact same time that 2.8 million ounces leave the vaults. The trend line is being tested at the exact same time the fear and greed index hits 18. The trend line is being tested at the exact same time JP Morgan pulls 1.6 million ounces. Every previous time in this bull market, when the price hit a major support level, while the physical market was tightening simultaneously, the support held every single time. October support held, the January support held, the $64 low held. Support holds when physical demand meets paper selling. At some point, paper sellers run out of contracts to sell, and the physical buyers are still standing there with their delivery notices. But here is what I do know. The fear and greed index is at 18. Extreme fear. Historically, when this index hits these levels, the market is within days or weeks of a significant bottom. Not because fear causes bottoms, but because fear creates the conditions for bottoms. Fear makes people sell at any price. That selling exhausts the supply of sellers. And when sellers are exhausted, the only direction left is up. At 18, seller exhaustion begins. Let me give you context on this number. 1 month ago, the fear and greed index was at 41. That was fear, but not extreme. 1 week ago, it was 25, getting worse. Previous close 21 and now 18. The trajectory is straight down into maximum fear territory. And each week, the number drops closer to the single digits, which is where historical capitulation bottoms have formed. I want to say something that might sound counterintuitive, but it is the most important thing I could tell you right now. This fear is good, not for your portfolio today. Today it hurts. But for the long-term setup, it is exactly what you want to see because extreme fear is what creates the conditions for the next rally. The crash from 121 to 75 has now destroyed every speculative long position. It has triggered every stop loss. It has scared every weak hand out of the market. It has pushed the fear and greed index to 18, and it has pushed COMEX open interest to 20-year lows. The market has been cleaned out, the speculators are gone, and what remains is the physical demand from institutions like JP Morgan, who are pulling million-ounce chunks out of vaults at the lows. Every major bottom in silver has looked exactly like this. Maximum fear, maximum capitulation, maximum vault drainage, and then the turn. I do not know if the turn is this week, but the setup is here. And the vault drain on the same day as the crash tells you the strong hands are not just holding through the fear. They are actively taking delivery. They are using the fear to accumulate physical metal at lower prices. While retail traders panic, sell their paper positions at $75, JP Morgan is pulling 1.6 million ounces of real metal out of the vault. While the fear and greed index hits 18 and everyone is terrified, StoneX is draining another 1.2 million ounces. The fear is the cover. The vault drain is the real story. And PPI being hot does not change the physical shortage. I want to be clear about this. PPI at 0.7% does not create more silver. Rate cuts being canceled does not fill the COMEX vaults. A strong dollar does not restart the Dubai flights or reopen the Strait of Hormuz. The macro headwinds from the PPI data are real. The dollar strength is real. The rate cut cancellation is real. But none of those things change the physical reality that silver is scarce, getting scarcer, and being withdrawn from vaults at an accelerating pace. The paper price responds to macro data. The physical market responds to actual supply and demand. And right now, the paper and the physical are telling opposite stories. Again, I have been through enough of these disconnects to know how they resolve. Paper wins in the short term, always. The algorithms are faster. The leverage is greater. The selling pressure from a hot PPI number is instant and overwhelming. But physical wins in the long term, always because you cannot deliver an algorithm. You cannot ship a rate cut expectation. You cannot build a solar panel with a strong dollar. At some point, someone needs the actual metal. And when they need it, and the vaults are 335 million ounces and falling, the price has to adjust to reality, not the other way around. I have watched this play out 4 times in the last 6 months. October, London froze, 0 offers. Paper said silver was 55. Physical said there is none. Within weeks, silver rallied to 70 plus. November CME halted, paper crashed. Within weeks, silver was making new highs. February, CME halted again, paper crashed from 91. Within weeks, silver was at 121 all-time high. And now March, PPI crashes, paper to 75. 2.8 million ounces leave the vault on the same day. Each time the pattern is the same. Paper crashes, physical tightens, a disconnect opens, and then the disconnect closes with a violent move higher. I'm not saying it happens tomorrow. The dollar is strong. Rate cuts are dead. The macro headwinds are real. But the physical market does not care about macro headwinds. It cares about ounces. And ounces are leaving the vault at $75. That is all you need to know about where the smart money thinks this price is going. Silver at 75 on the trendline support. Fear and greed at 18. 2.8 million ounces drained on the crash day. JP Morgan pulling 1.6 million from their own vault. The same vault they were fined $920 million for manipulating. PPI hot enough to kill rate cuts. Oil above 100 feeding the inflation loop. And the Fed trapped between inflation and recession with no good options. This is either the bottom or close to it, or it is the start of a deeper flush that takes silver to the 64 area one more time before the real recovery begins. Either way, the vault data tells you the smart money is not waiting. They are taking metal now at these prices during extreme fear, and they are taking it in million-ounce chunks. Drop a comment. Tell me what you think. Is 75 the bottom, or does silver flush to 64 first? Tell me what you think about JP Morgan pulling 1.6 million ounces on a crash day. Tell me if the PPI number changes your long-term view or if it is noise. I will pin the best analysis. Share this video with someone who sold silver today because they were scared. The fear and greed index says 18. The vaults say 2.8 million ounces gone. And JP Morgan says, give me 1.6 million ounces right now during the crash. One of those data points should make them reconsider. If you are new here, hit subscribe. I cover COMEX, vault data, crash analysis, macro data impact, and the physical versus paper disconnect that tells you what is really happening in the silver market. Links in the description. This is the hidden economy. Silver crashed to 75, gold crashed $171. PPI came in at 3.7, more than double the forecast. Core PPI at 3.9%, fastest in 3 years. Vegetables up 49%, rate cuts canceled, dollar pumping, oil above 100. The Fed trapped fear and greed at 18, extreme fear. And on the exact same day, JP Morgan pulled 1.6 million ounces from their vault. StoneX pulled 1.2 million, HSBC pulled 20,000, 2.8 million ounces of physical silver walked out of COMEX vaults on the same day the paper price crashed 5%. Silver sitting on the ascending trendline support at 75. The triangle apex approaching, the entire market terrified, and the biggest bank in the world quietly loading its truck with physical metal while everyone else runs for the exit. Fear is temporary. Physical silver is permanent. I will see you in the next